Welcome back to TalkTickers, your essential guide to cutting through the noise of earnings calls and getting right to the insights you need.
That's right.
Today, we're diving deep into the recent results from Airthings. We've sifted through their latest earnings call.
Yep, got the transcript right here.
To bring you the core operational performance, the key strategic moves they're making, and, well, the financial picture heading into the next quarter.
And what really jumped out in this call, I think, is a sharp divergence in their business.
Definitely. And some pretty significant questions about, the future path.
Absolutely. This quarter's report paints a picture of contrasting trends within the company, all set against a backdrop of broader market uncertainty.
Okay, let's unpack this complex picture then. What's the high-level snapshot from their first quarter performance?
At a glance, Airthings reported revenues of $9.2 million US for Q1.
$9.2 million. Yeah.
And that landed them at the lower end of the guidance they had previously provided. But the headline story, really, from the top line, is a clear split between their segments. You've got a notable decline in their consumer business, offset by significant growth in the business-to-business, or B2B, and the professional segments.
Right. That segment divergence is the first big flag. So how did that impact profitability and margins?
Well, gross margin showed an improvement. It climbed to 53% compared to 45% in the fourth quarter of last year.
Okay, that's a positive step sequentially.
It is, although stable relative to Q1 last year's 61%. So up from Q4, but flat year over year.
Got it.
But despite that sequential margin improvement, overall profitability remained negative. Adjusted EBITDA came in at minus $2.1 million.
Minus $2.1 million. And where does that leave them on cash?
They finished the first quarter with a cash balance of $5.4 million.
Okay. So lower end revenue, negative profitability, but some margin recovery, and these really clear internal segment dynamics. Let's dig into those Q1 financials in more detail.
Sounds good.
You mentioned the $9.2 million revenue figure was at the low end. What specifically drove the 13% year-over-year drop in the consumer segment?
Yeah, 13%. The company pointed to two main factors there. First, they experienced lower realized product prices.
Meaning the average price they actually got was down?
Exactly. And second, perhaps more significantly, they saw more cautious purchasing behavior from their distribution partners.
Ah, the channel partners.
Right. This seems directly tied to the overall uncertainty around U.S. consumer spending right now. Distributors are hesitant to stock up heavily if they're unsure about end consumer demand.
That makes sense. That macroeconomic uncertainty certainly weighs heavily on consumer businesses. But on the flip side, the B2B segment saw a big jump.
Huge jump, yeah.
How much growth was that, and what was the driver?
The business segment revenues increased by more than 50% year over year.
50%.
Now, it's worth acknowledging that Q1 last year was a relatively weaker quarter for that segment, so, that helps the percentage look bigger.
Okay, context is important.
But the growth itself is coming from reorders from large enterprises, which is a really positive sign.
Definitely.
It suggests strong customer retention and, satisfaction within their key business accounts.
Yeah, customer retention in B2B is absolutely critical for sustainable growth.
Yeah.
You touched on margins earlier. That jump from 45% to 53% sequentially sounds like good progress.
It is.
What's behind that improvement, and what are the differences between the segments there?
Well, gross profit overall was actually down 3% year over year.
Oh, okay.
But the margin percentage improvement from Q4 was a specific focus. They actively decided to drive improved unit economics.
Trying to make more per item sold.
Basically, yeah. The consumer margin is still under pressure. They said it needs attention. But the B2B and professional segments have healthy margins.
How healthy?
Well, the B2B segment had a very strong 78% gross margin this quarter.
Wow, 78%. That's strong.
Very strong. Actions they're taking include renegotiating contracts with partners and carefully managing marketing campaign spending.
So they're actively targeting better profitability on each unit, especially in those business segments where they seem to have more leverage.
What about recurring revenue? How did their ARR look?
ARR, annual recurring revenue, totaled $4.4 million.
Okay.
That's a 4% increase year over year. Again, the growth here is primarily driven by the B2B segment.
Makes sense, given the revenue jump.
Yeah, B2B ARR stands at $3.3 million, also showing 4% year-over-year growth. The professional segment's ARR is around $1.1 million, kind of holding steady.
And linking back to that negative $2.1 million EBITDA.
Yeah, that figure, the operating loss before, interest, taxes, depreciation, amortization. It's mostly explained by the overall revenue development we just covered.
Specifically, the pressure from the consumer side pulling it down.
That's the main story there, yeah.
Were there any other significant changes in the financial numbers that stood out?
Yes, there was a notable change in net financial items compared to Q1 last year.
Okay.
But this wasn't due to the core business. It was solely because of currency fluctuations.
FX swings. Exactly. The Norwegian krone is their functional currency, and its volatility against the US dollar caused a pretty significant swing in the reported numbers.
Right. Currency swings can definitely mess with the picture sometimes. Okay, moving on to operating expenses, OPEX. The company said they were under scrutiny due to the revenue pressure. What actions did they highlight?
Well, they mentioned seeing effects from the reorganization they did last year,
Okay.
which is leading to lower personnel costs, roughly $300,000 less this quarter compared to last year.
That's something.
It is. They're also being more cost conscious across the board, areas like travel and office expenses.
Well, a sense of but.
But they are seeing increases in software and marketing costs.
Okay, where are those increases coming from if they're trying to be cost conscious elsewhere?
The primary drivers for the marketing increase seem to be preparing for their upcoming launch with Target.
Ah, the new retailer. That's big for them.
Yeah, they view it as a very important new relationship, and also increased activity in Canada, which is a key market alongside the US.
So these are investments they see as necessary for future growth, even while tightening the belt elsewhere.
Exactly. Think of it as needing to spend money now to potentially unlock significant revenue later.
That makes sense, strategic investments, despite overall cost consciousness. Let's look at the balance sheet and cash flow now. Total assets decreased significantly year over year. Why the big drop there?
Yeah, total assets went from $60 million down to around $40 million compared to last year.
That's a big move.
It is. The main reason for this decrease was due to impairments they made back in Q4 of last year.
Impairments, so write-downs.
Exactly. An impairment means they wrote down the value of certain assets on their books because they were no longer worth what they were previously valued at.
What kind of assets?
In this case, it was specifically on goodwill and deferred tax assets.
Right. Goodwill from acquisitions and future tax benefit.
Yep. Writing these down indicates a reassessment of their future value or maybe profitability expectations compared to when those assets were put on the books.
Okay, so it's a non-cash adjustment reflecting a change in valuation expectations from last year.
Got it.
Revisiting the cash position, you mentioned $5.4 million at the end of Q1. How did they get there from the start of the quarter?
They started Q1 with $8.8 million in cash.
Okay.
And ended with $5.4 million. So their cash flow during the quarter was negative $3.5 million.
Negative $3.5 million burn. What were the main drivers of that cash burn?
The cash outflow was primarily driven by two things. First, the operational losses we discussed, that negative EBITDA.
Right.
And second, what they called negative working capital development.
Working capital. The money tied up in day-to-day operations.
Exactly. Things like inventory, accounts receivable money customers owe them, and accounts payable money they owe suppliers. Negative development means the cash tied up in these items increased.
And what drove that specifically this quarter?
In this case, it was driven by a slight increase in both inventory and accounts receivable.
Inventory management has been a focus for them previously, hasn't it? Where does it stand now?
It absolutely remains a high priority. The company had significant inventory challenges before, and they'd made progress reducing it.
Right.
However, they saw a slight increase from Q4 to Q1, ending the quarter with around $11 million in inventory.
$11 million.
Yeah. They noted that the uncertainty in the consumer segment makes planning production and inventory levels more difficult.
Makes sense. Hard to predict demand.
Very hard. A positive sign, though, is that the inventory mix is healthier now.
Oh, how so?
About 1/3 is consumer finished goods, but a larger portion, 43%, belongs to the B2B and professional segments.
Where demand seems stronger and more predictable.
Exactly. So, better mix is good, but the planning challenges in consumer definitely remain.
Okay. With that cash balance and the burn rate, do they have any funding buffers available? Any backup?
Yes, they do. They have access to a revolving credit facility of $5 million.
Credit line?
Yep. And that facility is available and valid throughout 2025, so it provides some potential liquidity if needed.
Okay, that adds a bit of a cushion. Let's pivot now. Let's talk strategy. Strategic direction, what this report tells us about the company's priorities. What are they focusing on?
They are really doubling down on safety-related products. They highlighted radon detection as the main driver here.
Radon.
Yeah. This is where they see the strongest market pull and, interestingly, a perception shift towards their products being a must have rather than just, nice to have.
That's a key shift if it's really happening. Are they seeing that translate into demand for those specific products?
Yes, they noted continued strong demand for their radon products in North America, particularly during the recent radon season.
Okay.
Their overall sell-through in North America increased by 28% year over year during that season.
28% sell-through, it's decent.
And for their popular Corentium Home 2 product specifically, sell-through was up a significant 45%.
45%. Okay, those sell-through numbers sound very positive. But wait, earlier you mentioned consumer device registrations were down. How do we reconcile strong radon sales with lower registrations? That sounds contradictory.
Yeah, that's a great question, and they actually clarified it on the call. It does sound contradictory, but the reason is pretty simple.
Okay.
They're seeing a bigger increase in sales of their original Corentium Home radon detector.
The older model.
Right. And this device is unconnected. It doesn't use the app, doesn't connect to Wi-Fi.
Ah, so it doesn't show up in the connected device registration numbers.
Exactly. So while sales of radon detectors overall are strong, particularly for that unconnected model, the count of new connected consumer devices being registered showed a decline.
Okay. Meanwhile, B2B registrations.
Up 15%, which aligns nicely with the revenue growth in that segment.
Okay, that distinction between connected and unconnected devices makes perfect sense of those numbers now. They're also trying to enhance the user experience, right? What initiatives did they mention there?
Yeah, a few things. They are launching the connected version of that Corentium Home product, the Corentium Home 2.
Right, the updated one.
They're investing in content to increase awareness, like a video collaboration with BBC Storyworks. They've upgraded the radonmap.com website, making it more useful. You can now search by state or province.
Useful.
And for existing users, they've improved the in-app experience. New home screen, much more reliable, Bluetooth syncing.
That's always good. Syncing issues can be frustrating.
They claimed over 70% improvement there. And showing more sensor values for now directly on the screen of their flagship View Plus device. Plus, they're rolling out a referral program.
Okay, so lots of little improvements aimed at making the product stickier and the data more accessible.
That seems to be the goal. It sounds like a push to engage users beyond just the initial purchase.
They also highlighted the potential of their vast data set. How big is that, and what are they doing with it?
It's substantial. More than 570 billion measurement data points collected over time.
Wow, billion with a B.
Yeah. They see significant potential in leveraging this. A concrete example they shared was a collaboration with Harvard University,
Oh, interesting.
studying the impact of the LA wildfires back in January on indoor air quality.
Okay.
By analyzing data from monitors in LA, they were able to determine and actually inform users that homes within 2 miles of the burn area were significantly affected by elevated particle levels.
That's powerful, using their network data for real-time insights during an event.
Exactly. It moves beyond just personal monitoring to potential broader insights about air quality, trends, and events, offers a different layer of value.
Yeah, that's a great illustration of how that data can be used. What does their customer feedback suggest about user engagement with the data? Do people care beyond the initial setup?
Well, they mentioned feedback showing that customers often start with a specific safety concern, like radon or particles. That's the entry point.
Makes sense.
But once they have the device and the app, their curiosity grows about other aspects of air quality. They shared an anecdote about a customer who initially bought for radon, but then used the app to set different focuses, maybe for productivity, or even tracking potential headache triggers, learning more about their indoor environment and how to improve it.
Huh. So the initial safety concern can lead to broader engagement.
That's what it suggests. The potential for deeper engagement if users explore the data beyond that initial safety driver.
That's an encouraging sign for long-term engagement and maybe adoption of more connected devices over time. Now, arguably, the biggest development from the call, the strategic review process they announced.
Yeah, this was definitely major news.
What exactly is happening there?
Okay, so they signed a letter of intent, an LOI, for a potential sale of assets related to one of their business segments.
Okay, sale of part of the business.
Potentially.
Yeah.
And building on that, they've initiated a broader strategic review process that includes all their business segments.
All of them. Wow, so everything's potentially on the table.
That seems to be the implication of a broad review, yes.
And are they seeing interest from outside parties?
Yes. They explicitly stated they've received interest from multiple parties for different segments of the business.
Multiple parties, okay.
They are currently in what's called a go shop period,
Go shop.
which means they can actively solicit Alternative proposals try to get the best deal possible, and they promise to update the market as the process moves forward.
Okay. What's the stated goal of this whole strategic review? Why now?
The company's stated expectation, their hope, is that the outcome of this process should strengthen the foundation for long-term growth for Airthings.
Strengthen the foundation, often con for needing capital or focusing the business.
It certainly can be.
Okay, let's look at their market view and outlook then. How are they feeling about the current quarter, Q2?
They describe the current market environment, particularly for consumer companies in the U.S., as experiencing rapid and unpredictable changes.
Sounds about right for consumer goods lately.
Yeah. So for Q2, their revenue outlook is in the range of $7 million to $9 million US.
7 to 9 million. How does that compare to last year?
For context, their revenue in Q2 last year was $8.7 million. So the midpoint is below last year. The high end is slightly above.
Okay, so a cautious outlook.
Very cautious. They made it clear that this outlook comes with increased uncertainty, especially regarding the sell-in process that's selling to distributors and retailers towards the end of the quarter.
Uncertainty about whether retailers will place orders.
Exactly.
Are they taking steps to try and navigate that uncertainty? Any mitigation plans?
Yes, they're looking at mitigation activities. They mentioned recent and ongoing renegotiations with partners.
Trying to shore things up.
Right. They're also proactively discussing potential tariff-related cost increases with key partners.
Tariffs. Always a factor.
And reviewing their total supply chain to see how they can lessen any tariff impacts. But they really hammered home that uncertainty is the key word for the current quarter's outlook.
Okay, uncertainty reigns. Now, given the cash burn and this big strategic review, there was also discussion about capital needs and their previous profitability targets. What's the latest on those targets? This seems crucial.
It is, and this is a critical point from the call. They are not reiterating their previous targets.
Not reiterating, so pulling back on them.
Effectively, yes. Those targets were achieving positive adjusted EBITDA in the second half of 2025 and for the full year of 2026. They're not standing by those in this report.
Oh.
They explicitly stated that recent developments add uncertainty to those specific targets.
So the timeline for reaching profitability is now explicitly uncertain. That's a significant change.
That appears to be the clear message, yes. They also stated that considering the situation, it is, quote, prudent to secure additional capital to ensure a robust foundation for long-term growth.
Prudent to secure additional capital. Tying it back to this strategic review, perhaps?
It certainly seems linked. They connected the ability to reach profitability targets to needing continued healthy revenue growth, especially in the consumer segment.
The segment that's currently struggling.
Exactly. Alongside the cost actions they are taking and evaluating, the implications seem pretty clear that securing this additional capital and strengthening the foundation is tied into the outcome of this ongoing strategic review process.
Okay, that puts the strategic review in a very important light. Briefly, let's just cover their geographic footprint. Where are they selling mostly?
Around 81% of their revenues come from North America.
Yeah.
U.S. and Canada are the key markets.
Okay, heavily North American focused.
Yeah. The remaining 19% is from the EMEA region, which is primarily Europe.
Got it. And finally, just to round off the current picture, based on their trends, do they expect the momentum in that strong B2B segment to continue?
Yes, they did state they expect that underlying growth and momentum in the business segment to continue.
Okay, good to know. All right, let's shift gears slightly. This is TalkTickers, and this is not financial advice. We've just completed a deep dive into the Airthings earnings call, really sifted through the details.
A lot to unpack there.
Definitely. So based on the company announcing this major strategic review, potentially selling off segments, confirming interest from multiple parties, and aiming to, quote, strengthen the foundation amidst cash burn and these uncertain profitability timelines. A highly speculative trading idea might be purely event-driven.
Highly speculative being the key phrase.
Absolutely. You could, purely theoretically, consider taking a long position. Essentially betting that the strategic review process leads to an outcome like a segment sale at a good valuation, or maybe even a full company acquisition that unlocks value beyond the current market price.
But that's exceptionally risky. It's entirely dependent on the outcome of that specific corporate action, which is unknown.
Totally unknown. Pure gamble on the event.
Right. And building on that striking segment divergence, we talked about the struggling consumer versus the robust B2B. Another highly speculative idea, maybe even more complex, could be a pair trade.
Okay, how would that work?
Well, again, purely illustrative. you might identify a different publicly traded company that is a pure play consumer discretionary business, maybe one with similar U.S. market exposure that's also facing headwinds.
Right, another struggling consumer company.
And you could consider potentially shorting that company while simultaneously going long Airthings.
Betting on Airthings outperforming the other consumer stock.
Exactly. The hypothesis, the gamble, is that Airthings' resilient B2B segment, or maybe a strategic shift from the review that focuses on or highlights that B2B strength, could lead to Airthings outperforming the struggling consumer peer, regardless of Airthings' overall financials or cash situation in the short term.
So focus purely on relative performance driven by the segment difference and the potential corporate action.
Precisely. But again, this completely ignores overall fundamentals, cash burn, execution risk. It's highly speculative, focused purely on that segment delta and potential strategic outcomes. These are just illustrative, highly risky concepts, not recommendations.
Absolutely, not recommendations. Okay, so wrapping up our deep dive into the Airthings earnings call. We saw a quarter defined by a really sharp split, didn't we?
Yeah, very clear divergence.
A consumer segment under pressure from cautious distributors, price points, contrasted with a growing and margin-wise healthy B2B segment driven by enterprise reorders.
Okay.
Overlaying all of this is that critical strategic review underway, potentially involving segment sales with the stated goal of strengthening the company's foundation.
Which comes alongside an acknowledged need to secure additional capital.
Right.
And explicit uncertainty around achieving those previous profitability targets.
While at the same time, they're focusing their product efforts on the strong market pull for radon safety and trying to leverage that vast data set they have.
That captures the essence of the call, I think. The market environment is challenging, especially for consumer-facing businesses right now.
No doubt.
And the strategic review introduces both complexity and, frankly, the potential for significant change in the company's direction.
Okay, so just to reiterate, this summary and any speculative ideas we just discussed are purely for informational purposes only. They should absolutely not be taken as financial advice.
Always conduct your own thorough research. Understand the significant risks involved in any investment or trade, and please consult with a qualified financial advisor before making any decisions.
Definitely. Now, as you think about everything we've discussed from this Airthings call, here's maybe a provocative thought to leave you with.
Okay.
Given the undeniable strength in their B2B segment contrasted with the struggles in consumer and the stated need to secure capital alongside this huge strategic review process, how much of the company's future value creation is now going to hinge solely on the outcome of that review?
Interesting question. Is it all about the deal now?
And does the persistent demand signals from large enterprises for their B2B products tell us something fundamental about the long-term potential of connected environmental sensing in the enterprise space, even if the consumer market remains, unpredictable?
Yeah, does that B2B strength signal a more durable underlying trend? Lots to consider.
There certainly is. A lot to consider as the situation develops. Thanks for tuning in to TalkTickers.